Alright, you're welcome to today's class. We're looking at financial account, and the professor of accounting, the account analyst, is going to take you on this course, and there's no other person than Professor Dr. Dare Sampson. You're welcome, sir. You're welcome, sir. You're welcome, sir.
Good morning, all. Thank you so much. I'm going to be looking at the application of double entry. And in the previous class, we just touched a little bit about it, but this time around, I want to elaborate it so that you can understand it. Now, what are we going to do in this class? We're going to look at the rules and the principles of double entry, then how to identify the disadvantage of transaction. Then we also need to look into that of the ways and format to present double entry. Then the lesson last, we look at the effects of the account. Now, previous class discussed about the principle, which states that for every debit entry there must be a corresponding credit entry. Therefore, every credit entry there must be a corresponding debit entry, vice versa. Now, in terms of rules and principles of double entry, the first thing you need to know in terms of presenting or applying that of the double entry, the first thing you need to know is that you need to know that is, there must be two parties, that is, at least two or more parties must be involved in terms of transaction. So when you are making a transaction, there must be at least two persons, that is, two parties must be involved. Maybe the buyer, that is the buyer and the seller. Sometimes it might be three parties. Now, when I mean three parties, that means there's something there, which is the bank. For instance, that's we have the buyer, the seller, and that of the bank. So maybe the bank is not the intermediary, that is the agent in between. So now, but in terms of that, when you are preparing the principles of double entry or applying it, the first thing you need to know is you need to know the parties. That is the main account that is needed to be prepared or to be presented. That's the first thing. Then the second thing is that there must be what we call the monetary terms, that is value. You know, when I'm doing a transaction, there must be a value in terms of exchange. So it must have value, that's the monetary terms. Anything that does not have the monetary terms, it does not apply in financial accounting. So that's for that. Now, then the next thing now is you need to know the person that is receiving and the person that is what? Giving. That is the receiver and the giver. Then we know that the receiver should be debited while the giver should be credited. So it's just a corresponding entry. Once you are crediting this, you debit this. If you are debiting this, you are going to credit the other one. So that is for that. Now we move to the identification of transaction. Identification of transaction. If you can remember the previous class, we said we have two types of transaction. Two types of transaction. We have the credit transaction we have the credit transaction and we also have cash transaction. So these are the two types of transactions. All we are saying is that when you want to apply your double entry, the first thing is that there must be what? Two or more parties involved, and then you must identify the main account. That is the main from those parties that are involved in terms of the transaction. Then the next thing is the value. You need to know the monetary value. That is how much is it. Then the next thing you need to know is who is the receiving, and who is giver. That is who is the receiver and who is the giver. And for you to know that, then you need to identify that. Then after that, then we look at the identification of transaction. We said that there are two types of transaction. We have the credit transaction and cash transaction. Then we move to the next one, which is the ways and format to present double entry. Now, we are looking at the ways and format to present the double entry. Now, the ways and format to present the double entry is that we have the vertical format. The vertical format. And we have that of the T format. So, we have the vertical format and also have the T format. So, these are the ways or the format to present the double entry. Now, looking at the vertical format, when I mean the vertical format, for instance, where we have something like this, let me use this illustration. This particular format is just like that of the general journal, that's the journal proper, where we have something like, we have the date, then the particular, then we have the folio, then we have the debit, and that of the credit. Now, this is the what's it called? The particular format. The date, the particular, the folio, the debit, and the credit. Now let's look at this illustration, this transaction. Here we have sales of goods. 50,000 naira cash. Then the date is 1st of January 2023. Now look at this now. This is a transaction now. Sales of goods 50,000 naira in cash. That is in cash. Sales of goods 50,000 naira in cash. Now this is a transaction now. Now we want to apply this, the rules. The first rule says that we need to what? Identify the main account. Now the main account there is the sales and that of the cash. The sales and that of the cash. And we said earlier that there must be what? A monetary value. There must be a monetary value. That is, there must be value there. The value there is how much there is what? The 50,000 naira, which is the 50,000 naira. Then we now move to the next step. That is, we need to know who to debit, who to credit. That is, who is receiving and who is the giver. Now, if you look at this, now sales of goods 50,000 naira in cash. Now, when we talk about sales, that is, you are selling something, the goods is going out. So that means that the sales will be credited. So I will now come here and write the date, which is 1st of January 23rd. Then the particular, what am I going to put there is going to be sales. Then, in terms of the debit and the credit, I'm going to put the value there. So the value there is 50,000 now. So, but in terms of sales, the sales is what? Is going out. We are selling the goods out. So it will be at the credit side. So we credit what? The sales by putting the initial value, which is 50,000 naira. Then the corresponding entry of this is now that of the cash, because I said earlier that the two-way account there is the sales and the cash. So the next thing we now write are what? That same date where the transaction takes place. That same date they will write what? Cash in terms of the particular. Then it should now be at the debit side, same value, 50,000 naira. Then that's they will balance it. 50,000, then 50,000. Now this is an example of that of the vertical format while presenting or applying your double entry principle. The date, the particular, the folio, the debit and the credit. The debit and that of the credit. Then the date. That is for that. Now, going to that of the T format, if you look at the T format, I would prefer you use the T format. Why? Because there are some cases whereby the same thing will appear. Maybe, for instance, they now do something like purchase of goods. Purchase of goods, 50,000 naira, cash, in cash. That is purchase of goods 50,000 naira in cash. Now you can see that cash appears. No, we have already done cash here. Then we now want to present cash. No, it will not be fine. That is why it is preferable to use the T format, because you can't just prepare cash again. Cash is another cash again. No, you don't do that. So that is why we normally use the T format, which looks like a ledger. Which is what we use while presenting or applying the double entry principle. While applying the double entry principle, we use the T format. That's the major thing. Now, the vertical format is just like that of the general journal. That's the general journal. We'll talk about that next class. That one is for general journal. Now, let's now look at how we can apply or present the T format. That is what we are going to look now, how we can present the T format. Now, while presenting our T format, we know that it looks like a ledger. It looks like a ledger. This is my T format. This is the T format. While presenting our double entry, so applying the double entry principle. Now we know that this side is our debit, while this side is our credit. Now I'm going to apply the two illustrations I gave earlier before. We said that sales of goods, 50,000 naira in cash. That's the first one. That same date. Now that same date again. Then we see what purchase of goods, 50,000 naira in cash. So I'm going to apply the double entry principle with this illustration using the T format. Now we have the debit, then we have the credit. Then we know that here is going to be our date and details, then the amount. That is the naira sign or dollar sign, whatever currency it is. But in this case, we are using the naira sign based on the question given to us. Then the same thing at the credit side, we have the dates, the details, and the amount. Now we have looked at. Now if you look at this now, sales of goods 50,000 naira in cash. So that means we need to identify the two main accounts we need to prepare. The two main accounts we need to prepare. We know that it is sales and cash. Sales and cash. That's the two main accounts we need to prepare. And we also know that this is a cash transaction. So now I'm going to prepare the ledger, which is the T format. So I'm going to write sales. This is now my sales account. Then the date is 1st of January 23rd. Then the details will be what? Cash. The details there will be cash. Then what's the value? That's what the monetary debt is what? 50,000 naira. Now, then we have another one, which is the principle. You know, we said that the corresponding of the credit entry should be what? Debit entry. Now we prepare the other one, which is the cash, because we said that the two main account there is sales and cash, and the value is 50,000 naira. Then sales is that the goods is going out, so that's why it's at the credit side. Then the cash, that is you are receiving the cash. You know, when you are selling something, once you sold the item, you need to receive the cash. So the cash is coming in while the good is going out. So as the good is going out, that's why we credit it. While as the cash is coming in, that's why we debit it. Which is what we are applying here. Now the sales account there, we know that it should be at the credit side, which is there already, which is this. Now then we need to prepare the cash. Now to prepare the cash, there we have the date and the details, or we call it particular, then the sign, the currency. Now it will be at the debit side. Why? Because the cash is coming in. Just for instance, looking at this application, just like I'm selling something to someone, then the person is the goods is going out, then I'm receiving the cash. So that's what we're saying. Now, then write the date. What's the date there? Which is the what? 1st of January 2023. Then the date there is the corresponding of the account, which is what? Sales. So we write sales here. Then the value is 50,000 naira. 50,000 naira. Now, that one might wait. Now, move to the next one. We are done with this transaction, the first transaction, sales of goods, 50,000 naira in cash. Now, the next transaction there is purchase of goods, 50,000 naira in cash. Now, since purchase of goods, 50,000 naira in cash, then the next thing now is what are the two main accounts that are required or to prepare there, which are the purchase and that of the cash. That's the two main accounts you need to prepare there. Now, while preparing that, already we have already prepared our cash here, so you don't need to apply it again. So you just post it there. Now, then next thing now is who is receiving? Who am I to debit? Who am I to credit? Now, in this case now, purchase of goods in cash. We already know that this is a cash transaction. Now, purchase of goods, 50,000 in cash. It means that we need to debit one and we need to credit one. Now, who am I to debit? Who am I to credit? Now, you are purchasing something. While you are purchasing, that means the cash is what going out. You know, you are buying something, you need to pay for what you purchase, what you buy. So that is why you what? You debit purchase, then you credit cash. You debit purchase, you credit cash because you are spending, you are buying. So you need to pay for what you are buying. You need to pay an amount for what you are buying. So that is why we are going to prepare that of the purchase account, because we are going to prepare our purchase account. Where we have debit, then we have the credit, then the date, the particular, then a dollar sign, then likewise the same thing here, date, particular, and that of the currency sign. Now then what the name of this one is purchase account. Why? Because the two main account there is the purchase and cash. Now we know that purchase is going to be at the debit side because you are receiving the goods. What you purchase, what you buy, you receive. While you pay for what you purchase, the cash is going out. So that is why you debit what? The purchase account. Then the date is still what? 1st of January 23. Then you write what will be there will now be what? Cash. Then the value, which is still what? The money terms, which is 50,000 naira. Then the corresponding entry of this transaction, which is going to be the cash, because we know it is purchase and cash, so it will be at the credit side because the money is going out. You are paying for what you purchase. So the date, which is still the same day, which is going to be 1st of January 23rd. Then the particular day will be purchased. Then the value will still be what? 50,000 naira. So this is how to present apply our double entry principle while using the T format. Which looks like a ledger. We will discuss about ledger as a topic. Now that is how the T format looks like. That is for that. Now, then we now move towards the effect of the account. What do you mean by the effect of the account? You know, it's either the money is increasing or is decreasing. It's either your asset is increasing or is decreasing. It's either your income is increasing or decreasing, depending on the asset or the income or the expenses. Now let's look at this as an illustration. Looking at this one, sales of goods 50,000 in cash. Sales of goods 50,000 in cash. If you look at that, we say we have the cash and we have the sales. That's the two main accounts from that first illustration where they say sales of goods 50,000 in cash. We know we have the cash and sales. Now, if you look at that, now what will be the effect? Looking at the effect there now, what will happen to sales? Sales increase. There will be an increase in terms of income because you are selling. Once you are selling, money is coming in. Immediately you sell, the money is coming in. That is your revenue is increasing. So that is why we call it increase. The effect there will be increase in income or revenue. Increase in income or revenue. Majorly we call it revenue. We call it revenue. Why? That's another word for sales. So increase in revenue. Now if you look at the cash, what will happen to the cash? The cash will also increase in terms of cash. That is, you are making more sales, then your money is also what? Increasing. So they are making more sales while your cash is increasing. For instance, let's look at this illustration now. Now I have a shop, I'm selling an item. Now, maybe let me use this as an illustration. I'm selling maybe cars. I'm selling cars. So I want to sell so that I can make more profit, more gain. So immediately I sell, what happened to it? That means my revenue will increase because I sold the car. Now, once I sold the car, what will happen to my cash as well? My cash will also what? Increase. That is the effect. Not just the cash initially, it will be increase in assets. Because why is that increase in assets? Because immediately I collect the cash, I can use to get another one. That's why it's increased. Because I sold the car, I received the cash, then I can use that same cash to get another car. Then what will happen now? The sold that listen, I cannot get a car or purchase another car until I sold the car. I don't know if you are getting me. I cannot get another car until I sold a car. So that is why the cash will increase in terms of assets, then the sales will also increase in terms of revenue. So we are going to stop here. Then the next thing we are going to look at the question, because most cases in JAMB they mostly ask on this aspect, which is what should be debit, what should be credit, and they will also ask you that which one is increased, which one is decreased, or which one should be increased. That is the effect. So that is of that. If you have anything or any question, you can drop it on our comment box there, so we can attend to it. Or anything you don't understand, or maybe outside anything we have been saying so far, we can drop it there. So God bless you. Thank you.
All right. Thank you, sir. Thank you, sir. So this is the end of today's class. We'll be looking at you dropping, we'll be waiting for your comments, I mean to say, we'll be waiting for your comments and your questions on financial account. We're always there to help you. Meanwhile, keep studying, keep working. The sky is your starting point. See you.
Okay,